Hello everyone and welcome back to another video. In today's video, there is a lot that I want to discuss. But first, I want to officially announce that I got married over the weekend, which is why I have taken about a 2-week break from making public YouTube videos. I really just wanted to focus on my wedding, enjoy being in the moment, and it was incredible. The day could not have gone any better, and I am extremely blessed and happy to be with the beautiful wife that I now have, which is also new to say. And thank you so much in advance for all of the comments that I'm probably going to get on this video about my marriage. But with that being said, let's now get into what we are going to be discussing in this video. So first off, Figma did file an S1, and it looks like the company wants to IPO. This is a very hot topic in the market right now, and I have been asked to go through Figma's S1. So we're going to take a look at their financials, and I'll share my thoughts on the business and their potential IPO, and if I'm going to be buying the stock. Amazon is also scaling up its robots, and Jeff Bezos is selling a lot of shares, so I want to discuss Amazon stock and what's going on there really quickly. Perplexity launched a new web browser called Comet, which is competing with Google Chrome. OpenAI also announced it's working on a brand new web browser, literally right after Perplexity announced Comet. So these two AI companies are now trying to attack Google Chrome, and it looks like Google's moat is continuing to come under attack, so I want to discuss my thoughts there. I have also been noticing some seriously bubbly and risky stuff going on in the markets, and I want to warn you about the specific sector that this is happening in, and the type of stuff that I personally am avoiding as an investor. And I just want to make everyone aware of the type of stuff that I see going on, so that you can at least know the risks and make better decisions for yourself. There was also a discussion on X about selling your winners the other day, so I want to share my perspective on when to sell and if winners should be sold. There was also a heated discussion about finance influencers and if they should hide or show their portfolios publicly. So I want to weigh in, share my perspective and what I do personally, and kind of my logic behind what I do and what I share. And then lastly, I will share one new international stock that I have been buying, because in my last video, I kind of went over why I think the United States market is so expensive, why I'm moving away from the United States market, but then I didn't share any stocks that I have been buying in the international markets. And a lot of people were actually kind of upset about this, so I will be sharing one stock, okay? Just one, because a lot of the international stocks that I have been buying are smaller cap companies, and this one is kind of mid cap. It's a larger company, so I'm comfortable sharing it on my YouTube channel. So this is going to be an absolutely action-packed video, so let's just get right into it and start off with the Figma IPO. First, let's discuss what Figma's business actually does. Figma provides collaborative, cloud-based design platforms that allow teams to create, prototype, and share user interfaces and experiences together in real time. Think of it like Google Docs, but for graphic design. Multiple people can work on the same design project simultaneously from anywhere with an internet connection. So I went through Figma's S1 filing and I took screenshots of all of the highlights that I found. And this says, millions of people use Figma every week, often for hours a day. And as more users have come to our platform, our business has grown. The company has $821 million in trailing 12 months revenue. Its revenue has grown by 46% year over year, and it has an 18% non-GAAP operating margin. So the company's producing almost $1 billion in trailing 12 months revenue, and it's growing at 46%, which is pretty dang impressive. Figma also reports that it has a 91% gross margin, a 132% net dollar retention, 78% of the Forbes 2000 companies use Figma, and 76% of their customers use 2 or more products. So Figma seems like it is a highly profitable business that a lot of the largest companies in the world are using, and they're also able to sell multiple products to their customers, which is why their net dollar retention is 132%. So they are able to increase their prices and offer more products to generate more revenue to their existing customers. That's why the net dollar retention is so high. Figma also showed their paid customers with more than $100,000 in annual recurring revenue, and they have over 1,000 customers now with over $100,000 in ARR. And this number has more than doubled since March of 2023. So over the past 2 years, they have successfully been able to continue increasing their average revenue per user and growing the business that way. So now let's head over to Figma's income statement. And we can see that in the first 3 months of 2025, they generated $228 million in revenue versus $156 million of revenue last year. Its gross profits also came in at roughly $209 million, which means that their gross margin is that 91% that they showed us earlier. However, their income from operations is only $40 million, which is pretty low relative to all of their gross profits. So the company is spending a lot of money on operating expenses. I don't have it underlined, but last year in 2024, we can also see that their operating expenses were $1.54 billion. And Figma's loss from operations was $877 million last year. This was a huge point of contention that I saw online, with a lot of people saying, what was this massive operating expense? And why is Figma doing $1.5 billion of operating expenses in 2024? And will this continue going forward? So when I see things like this on a company's financial statements, what I do is I go and try and find the answer. I don't just leave it at this, and I try to see if this is a one-off major expense or if these expenses should be expected going forward. But let's move on to the next screenshot, which discusses the large amount of operating expenses last year. So this says, following the abandoned merger with Adobe, we wanted to provide existing equity holders, including holders of RSUs, the opportunity to sell a portion of their eligible equity holdings in a tender offer, resulting in recognition of stock-based compensation expense, net of amounts capitalized, of $801.2 million during the year ended December 31st, 2024. Our operating expenses increased significantly during last year, as compared with 2024, as a result of the May 2024 RSU release and 2024 stock options grant. So for those of you who may not know the full story here, Adobe tried to acquire Figma in 2024, and there was a $1 billion termination fee. So if the acquisition didn't go through for any reason, then Adobe had to pay Figma $1 billion, just $1 billion flat. Now, what Figma did with this money is it seems like they accelerated their equity plan for their insiders and their employees, and they basically gave them the option to be bought out. It was kind of like a liquidity event. And I imagine that this happened because the insiders and the employees of Figma were probably hoping that this Adobe acquisition would cause a liquidity event for them to get some liquidity and some cash out of the business. Then when the acquisition was terminated, Figma took that $1 billion and gave the insiders and employees the option of being bought out of their shares. That is why the operating expenses were so high last year. And then my question is this a recurring expense? And in my opinion, this is kind of like a one-time special situation that I don't think will continue happening going forward. So I don't think that this is a massive red flag. I actually think that it's kind of cool that Figma did this. And if I was an employee of Figma or an insider of Figma, I probably would have taken some cash off the table for all of the hard work that I've done over the previous few years. And it's cool that Figma gave them the option to do so. So no, I don't think that the massive operating expenses last year were a big red flag, and I think this all makes sense. So now let's move on to Figma's cash flow statement. And last year's cash flow statement was interesting with the $1 billion payment and the expenses for all of that. So in the most recent quarter, we can see that Figma produced $97 million of operating cash flow. Their capital expenditures were only $874,000. They had capitalized internal use software development costs, which means that their free cash flow came in at roughly $94.6 million. So Figma is actually a very, very profitable business. And right now it seems like the company is producing about $400 million in annual cash flow at this very moment. We can actually see that their free cash flow margin is 41% as of the first quarter. If Figma can maintain a 40% free cash flow margin going forward, then the company could do about $400 million in annual free cash flow. Then I was looking through some articles and I found this. Fields said in the letter that as a public company, investors should expect us to take big swings, including through acquisitions. Figma has also begun investing in digital currencies. In 2024, Figma's board authorized a $55 million investment into a Bitwise Bitcoin exchange-traded fund. And this is where we start to get into things that I do not like. I personally do not like that Figma is saying investors should expect us to take big swings, especially when it comes to acquisitions. This kind of suggests that Figma is willing to take on large acquisitions and be aggressive with them. And this kind of is hinting or suggesting to me that Figma is going to do expensive acquisitions. Like, I don't know, it just comes across to me like they're willing to pay very high prices, be extremely aggressive to acquire competitors and expand their business. This kind of language reminds me of the TDoc Livongo acquisition that happened in 2021. Where TDoc paid something like $14 billion for Livongo. It was a massively overvalued acquisition, and it was very hyped up. And the language that Figma is using here kind of suggests to me like they're willing to do extremely expensive acquisitions as well, which actually destroys shareholder value. And that is a red flag for me. The next red flag for me personally, just as my own investor, is that Figma is investing in Bitcoin exchange traded funds. I don't even know what that means, but it seems like the company is willing to invest its capital into Bitcoin or crypto or kind of speculate in crypto. And if you've been watching my channel for some time, you probably know that crypto is just something that I am completely not interested in. I think it's a very speculative. And if Figma is wanting to go down the route of investing a lot of their cash into Bitcoin, it's actually going to be a red flag for me. And these two things right here, them saying that they have an aggressive acquisition strategy and they want to invest in Bitcoin, is enough for me to not be interested in the company, because the management seems to be doing things that I personally would not be doing and I would not be comfortable with. Now, this next screenshot says that Figma didn't say how many shares it plans to sell at the IPO. The company was valued at $12.5 billion in a tender offer last year, and in April it announced that it had confidentially filed for IPO with the SEC. So last year in 2024, Figma was valued privately at about $12.5 billion. Now, as we just saw, Figma is growing its revenue currently by 46% year over year and probably doing around $400 million in annual free cash flow. So I think that this company could probably trade for 35 to 40 times free cash flow and be considered around fair value on the market today. That would put the company's valuation around $15 to $16 billion. So when Figma announces their IPO and the actual IPO price, if it's over $16 billion, then I personally think that the stock is going to be overvalued and start looking expensive. And I'm almost sure that it's going to be a lot higher than 16 billion because their last private round was 12.5. And this is a pretty hyped up company. Like, I've been asked about this company a lot. So yeah, I would be surprised if the IPO price is 16 billion, and it's probably going to be much higher. So I'm just not really going to be interested in it. That, coupled with the fact that Figma is aggressively pursuing acquisitions and wanting to invest in Bitcoin, it's enough for me to just pass on it. I don't have to own everything in the market. It's probably going to be overhyped, and that's kind of my perspective and opinion on the Figma IPO. The financials of the business look fantastic. It's growing, it's highly profitable, it's got a great balance sheet, it's generating free cash flows, but the management and the potential price is gonna deter me from wanting to invest in the Figma IPO. So now let's move on to the next topic, and that's that Amazon is deploying a lot more robots throughout their business and their distribution facilities. So these charts popped up on X the other day. The first one on the left is the number of Amazon employees per facility, and the one on the right is the packages handled by Amazon end-to-end per employee. And we can see that since 2020, the number of employees per Amazon facility has been coming down quite a bit. It was roughly almost 1,000 in 2020, and now it looks like it's somewhere around 700, so it's dropped by about 30%. So there are less employees needed to operate Amazon facilities. Now what's interesting is the packages handled by Amazon end-to-end per employee is absolutely skyrocketing. In 2020, it looks like it was about 2,600 packages per employee, and now in 2025, the most recent data is showing us that it's near 4,000. So just over the past couple of years, the effectiveness or efficiency of an Amazon employee in their warehouse has increased by roughly 50 to 60%. This is because Amazon is leveraging robotics and they don't need nearly as many employees to run their fulfillment centers. This next screenshot right here is actually from ARK Invest, but it's actually still a good chart. This is Amazon's employees and robots at the start of every year. And we can see that Amazon's employees topped out here at 2022 at about 1.6 million employees. And it's actually come down to about 1.56 million employees as of 2025. However, if we take a look at Amazon's robots, they have consistently been growing and growing and growing. And in 2025, Amazon now has over 1 million robots deployed throughout the business. This is something that I think a lot of investors do not consider with Amazon's business, is the fact that they're probably one of the largest robotics companies in the world. And they're seriously leveraging robotics, and I think that Amazon will only continue to do so and increase the efficiency of their fulfillment networks, lower their employee count, and increase the vastness of their robotics and what their robots can actually do. All of this should ultimately lead to Amazon's margins continuing to expand as they have been over the past about 14 years, which is part of my personal investment thesis with Amazon. I think that Amazon's margins are going to continue expanding over the long term, which is going to cause its profits to continue growing at a faster rate than its overall revenues, and that is how Amazon will be able to maintain a compounded annual growth rate of above 10% to their cash flows going forward, at least in my own opinion. Now, moving on to the not so fun discussion about Amazon is that Jeff Bezos has been selling a lot of shares in the public stock market. On July 3rd, he sold about $208 million worth of shares. And then on July 7th, he sold another $458 million worth of shares. So in the past week or so, he has sold about $665 million worth of Amazon shares. On June 27th, he also sold $683 million worth of shares. So over the past couple of weeks, actually, he sold about $1.3 billion worth of Amazon shares. And I saw people on X saying that this is a major red flag, and what does Jeff Bezos knows that the public doesn't? Why is he selling billions of dollars worth of shares? And pretty much just being upset about this. My perspective is that insider selling is not always a red flag. With pretty much everything in investing, it's not black and white. There's almost nothing that's black and white. You have to think about it on a situational basis. So when we say Jeff Bezos just sold $1.3 billion worth of shares over the past couple of weeks, that sounds like a massive insider sale, right? But Jeff Bezos still owns 900 million shares of Amazon. This guy still owns over $100 billion worth of Amazon shares. So for Bezos, this is a trim in his portfolio. And you have to think about it. This guy is going and having extravagant weddings. He's funding Blue Origin. He's living up life. He's retired. And he's probably just wanting to have some fun. So he's probably selling these shares to afford his lifestyle as one of the richest men in the world. So this is not necessarily a red flag for me. He's still massively invested in Amazon's stock. And he's probably just selling some shares to afford his other businesses, fund his other businesses, and afford his lifestyle. So no, I don't think that this is a red flag for me. And I think that people need to think more rationally and logically, and not just think that insider selling altogether is always a bad thing. Now that we're on the topic of Amazon, I quickly want to discuss its valuation today as well, using Stock Unlock's upcoming historical valuation tool. Well, it's really the historical insights tool. And here we can see that Amazon's valuation looks like it is good today. The dark green suggests that Amazon is looking quite cheap, and the lighter green means that the valuation is looking good. Whenever the valuation goes to orange or red, that means that it's looking bad or very bad. So right now, Amazon's valuation doesn't look too insane. And I would actually agree with this, because Amazon is trading for a price to operating cash flow ratio of about 20, which is well below the company's historical averages of about 25 to 27. So relative to how this stock has traded historically, it is actually selling for a discount, despite its margins continuing to expand and the company having a long runway for growth ahead of it. So in this case, I do agree with Stock Unlock's valuation right here. And I think that Amazon's valuation is looking good, but I also think the company is approaching fair value and it's not super undervalued anymore. So those are my thoughts on Amazon stock today, its valuation, and the recent news that has been coming out with this one. All right, let's now move on to the next major piece of news, which is that Perplexity is launching its own web browser to directly compete with Google Chrome. Yesterday, the CEO of Perplexity put out a tweet responding to Google Chrome that said, "Neither. I am an open comment assistant on the sidebar guy. See you tomorrow at Google Chrome." Then he put out another tweet that said, "Users should be asked to select their default browser during onboarding on Android." Something like this. Chrome shouldn't be forced as a default browser on Android. And we can see that he was suggesting that comment should be an option for the default search browser on Android devices. His next tweet said, "You can add repeat tasks to comment on your new tab page widgets. This will become your command center for customizing your life. And over time, AI will just figure out the repeat tasks for you on its own." He's making it sound like Comet will be like an AI agent web browser, where you can tell it to do things for you and it will go out and do them, so that you don't have to manually go and do all of your tasks that you currently do on your web browser. I actually found a couple of videos of people using Comet that I want to show you because they're doing exactly what I just said. They're using Comet as an AI agent to do tasks on the web for them. So I'll play the first clip and then we'll discuss it afterwards. In this first video, the person told Comet to go through their email inbox and find all of the emails from certain companies that they could unsubscribe from their emails in the future. Comet then went through the Google inbox, found all the emails, and successfully unsubscribed from them. This ended up saving the user a lot of time because they didn't need to manually go through their emails and find the unsubscribe link and unsubscribe and go through that process. Comet just did it. So I do think that in this use case, it was incredibly useful and saved this person a lot of time. This is actually a use case that I would find useful because, one of my email inboxes just over time has gotten incredibly crowded with spam and promotions and whatnot. So if I could tell Google Chrome to go through my inbox and just unsubscribe me from all of this stuff, I would actually use it and it would be pretty efficient. But now let me play you the second video that I found, and then once again, we'll discuss it afterwards. In the second video, the person asked Comet to go through their emails and show them the emails from their work team. Then Comet brought up all of the emails, showed them to them, and the person said, hey, I want to schedule a meeting with this person on my team at a time where we both have availability on our calendars. So Comet went over to their Google calendars, found a time where they both were available, scheduled the appointment, sent out the email, and the notification for the person to accept. All of this was done without the person actually doing anything really other than telling Comet that, hey, this is what I want to happen. So imagine if in Google Chrome, you could get Google to summarize all of your emails, all the important ones that you need to know, and just tell it to make calendar invites and schedule your day like that. This is pretty dang useful. And this is what I mean by Comet looks like it's an AI agent web browser that can just start doing tasks for you. You simply tell the browser what you want to happen, and it will go through all of your data, all of your emails, your calendar and everything, and do it for you. And I do think that this is pretty awesome. But what I do not think is awesome is that Comet is currently $200 per month. This is not currently a wide consumer product. Like, this is $2,400 per year. This is not something that I would pay for, and this is not something that I think a lot of people would pay for. And currently, we do not know if this is always going to be a paid web browser or not, but if it is a paid web browser, then I just simply do not see it being used by billions of people across the planet. Web browsers are something that people expect to just be free now, so a paid web browser is just, I don't know. I don't think that it's going to catch personally, and it would be a big hurdle for me to want to pay for it. And that's kind of the difference between Perplexity's whole business model and Google. Google's business model is entirely based on ads. Well, they have Google Cloud and whatnot, but the largest portion of their business model is simply ads. And this is because Google has billions of people around the world interacting with their products on a daily basis, so they can generate significant amounts of ad revenue. I was actually listening to a podcast by Perplexity's CEO. He was on the Lex Fridman podcast, and he said that he isn't confident that Perplexity is going to go down the advertising route, or if they're going to remain a subscription platform or what. But the reason that Google can offer free products like Chrome, Gmail, and etc. is because they have so much advertising revenue and different business units that are generating a significant amount of cash flow. And that's the business model. And I don't know if Perplexity can replicate that business model without getting billions of people on their platform. So I do think that Google currently has the competitive edge, and it's going to be extremely challenging for Perplexity and OpenAI to compete with Google's moats and Google Chrome. Google Chrome's market share has also been consistently increasing over the past decade. From May of 2016, Google Chrome had about 45% market share globally, and in June of 2025, it is now up to 68%. So Google Chrome has been continuing to take market share away from its competitors over the past decade, and it looks like it's currently at an all-time high. So I am reluctant to believe that these new web browsers are going to catch on and take massive market share from Google. But overall, it does seem like companies are continuing to try and take market share from Google in terms of Google search, LLMs, and now in terms of web browsing. But one thing that I do think is going to come away from all of this is that Google is going to have a stronger case that it is not a monopoly, because there are many different government agencies coming at Google saying, well, you're a monopoly and you need to break up, and we need to break up Google Chrome and separate it from Google's business, and you have to sell Google Chrome. But the fact that Perplexity and OpenAI are now openly attacking Google Chrome and trying to enter into this market, again, I think that it's only going to strengthen Google's case and potentially allow them to keep more of their business and not have to split up their business. Because, yeah, their mode is being attacked on all angles right now, and we're just going to have to see how it plays out. One other thing that I could see coming from all of this is competitors forcing Google Chrome to improve. This is what happened with Google Search and with Gemini. Google kind of got hit by OpenAI when ChatGPT was launched, and it kind of forced Google to have to innovate and improve their products. I think that this could be happening with Chrome, because I think Google could build Perplexity's Comet. And I think that Google could add AI agents to Google Chrome to do what Perplexity is doing. I was looking at the pros and cons of Perplexity and Comet, and there's a consensus out there that this is like a layer on top of Google Chrome, or like a feature, a new UI, a new interface on top of Google Chrome. And if that's the case, then it's kind of like, well, why couldn't Google Chrome just build this and build these features on top of what they already have and improve the usability? That's kind of been Google's playbook with AI so far. Whenever a new company comes out with a new product, Google just kind of improves on it and then actually makes it better, in my opinion. And I think that they will successfully do this once again with Google Chrome. So I personally am hesitant to believe that their market share is going to be taken or their mode is going to be successfully attacked. But it is interesting to see that these AI companies are attacking Google on all fronts. And that's my opinion on the situation going on. All right, now let's move on and discuss the bubble that I think is currently going on in the stock market. This article from Yahoo Finance says Bit mining surges 250% on Solana pivot. Further down in this article, it reads, cryptocurrency miner Bit Mining is shifting its focus to Solana, with plans to raise up to $300 million to acquire Solana tokens. Bit Mining said it wants to capture emerging opportunities across the broader blockchain industry and attract investors seeking to expose Solana. So basically what happened here is this company, Bit Mining, announced that, hey, we want to raise $300 million and plow that money into Solana cryptocurrency. And on this announcement, the company's share price rose 250%. The way that I view this is the company is diluting shareholders massively. And on the announcement that it's diluting shareholders massively, its stock rose. That is like a reverse reality situation. This is not what should happen. Typically, when a company announces that it's going to be diluting you as the shareholder to raise money, its share price should go down because more shares are being offered and your stake in the company is being diluted. This is the reverse of what is going on in the market, specifically in the cryptocurrency space right now. And I have another example. In this next article, it says, GameSquare completes $5 million Ethereum purchase as part of a $100 million treasury strategy. Then in this article, it says, this marks the first deployment under the company's $100 million Ethereum treasury authorization aimed at building a differentiated crypto-native treasury management strategy. And this is another example of a company that is currently diluting its shareholders to raise money to buy Ethereum, and its share price is going absolutely nuts. I believe that this company's ticker is GAME. So if we go and take a look at GAME here on Stock Unlock, we can see that I guess the share price is down 14% today. But over the past month, this company's share price rose something like 300% on the announcement that it's diluting shareholders to go and buy Ethereum. Again, this logically makes absolutely no sense. And this is the type of price action that I have seen in historical bubbles. You guys, I've been around now for almost a decade on YouTube making content and investing. My first investment experience, how I got into investing, was by getting involved in the cannabis bubble back in 2018 all the way through 2021. And this type of price action is the exact same thing that I saw. And I also saw companies diluting, raising money, and then seeing their share prices go up on that dilution because investors were like, oh, well, now they can go and buy more cannabis facilities, and that's going to be a good thing for us as investors, so we got to buy more stock. Look how that played out. That was a massive bubble. This also happened in the electric vehicle industry. And now it seems to be happening again in the Bitcoin and cryptocurrency industry. Like, if we take a look at the fundamentals of this business, let's take a quick look at its insights. This company's gross margin is 15%. It has negative operating margins, negative net margins, and its free cash flow margin is negative. The company also has negative ROIC of 308%. It's just losing a significant amount of money. Its revenue is declining, gross profits are declining, net income declining, operating cash flow declining. It has 2 months left of cash at its current burn rate. It has grown its share count by 111% over the past year, and it has negative book value, which means that it has more liabilities than total assets. This company is losing a significant amount of money, and it quite literally was about to run out of money. At its current burn rate, as Stock Unlock just showed us, it would run out of money within 2 months. So what does the company do? Well, it says, hey, we're going to raise some money and we're going to go and buy some Ethereum. What happens? Well, the share price shoots up 300%, and now the company can raise a lot more money. That is exactly what Bitcoin mining, I think the ticker symbol is BitCM. That's exactly what this company right here is doing as well. If we go and take a look at its insights, its profitability is extremely bad, its management is very bad, its growth apparently is a little bit better, but its financial health is also terrible. It had 1 month left of cash. It literally had 1 month left of cash. And now they're going out, they're raising $300 million, and they're saying, hey, we're going to put that money into Bitcoin or whatever, into Solana, and we're going to become a Solana-focused company. And now the share price is up 154% on the day. This is absolute insanity. Like, let's go and take a look at its balance sheet and its cash position. This company's cash position has been steadily declining for years, and it got to the point where it was sitting on $3 million of cash as of its most recent quarter. Now, at the same time, it's losing $20 million per quarter in operating cash flow. So it literally had a month left of cash. So what does the company do? They put out a press release saying, hey, we're going to go and raise money so that we can buy Solana. And currently the market and investors are like, cool, that sounds good. We'll buy up your stock and you're going to be up 150% on the day. This is a freaking bubble. This is a bubble if I've ever seen one. It's the absolute reverse of sanity. It's insanity. And people are throwing fundamentals out of the window now. No one's looking at the fundamentals of these companies when they're buying them. It's just, hey, this company announced they're raising money and they're going to go and buy Solana. So we're going to shoot the stock up. It's pretty crazy. So I've been noticing that this is getting more and more wild in the market. The crypto space seems to be getting more and more speculative. It seems to be more gambly, and it seems to be in an absolute bubble, in my opinion. So this is the kind of stuff that I've been seeing out there kind of going on a daily basis now. And I just wanted to let you guys know that this stuff is happening. So if you see these stocks like Bit Mining going up 154%, and you are not aware of how terrible these companies' fundamentals are, then just be careful, because these are not fundamentally sound companies. They're running on pure speculation, pure hype, and because there's a lot of excitement in the crypto space right now. So that's what I wanted to say, and just be careful. Try to focus on fundamentals, or at least understand what you're getting yourself into. Like, it's okay to speculate, but at least know that you're speculating and that the fundamentals of these companies are just absolute trash. And I cannot be more blunt about that. It's absolute trash. So now let's move on to the next topic of discussion, which is selling your winners. So there was a pretty good finance influencer on X who put out a tweet saying, the biggest mistake that you can make is selling your winners when you're investing. Now, this is also a heated discussion because a lot of investors say that you should never sell your winners. And Peter Lynch even said that you should not trim your flowers to water the weeds. As I said earlier on in this video, I don't think that there's anything that is black and white with investing. There has been times where I have sold my winners and it turned out to be an absolutely fantastic move, and it was 100% the right decision for me to do. A perfect example, my favorite example, is TELUS. So TELUS is one of Canada's large telecom companies, and in October of 2020, I was buying the stock around $22 per share right here. Then over the next about couple of years, the stock ran 53% to $34 per share. And I sold my shares right here in April of 2022 because I thought the stock was getting overvalued. This is not a fast growing company, okay? When it was at $22 Canadian, I thought that it was looking potentially cheap. And, this company is growing 5 to 7% annually, but the share price rose 53% over the next couple of years. And it got to a point where I was like, well, this thing is looking overvalued now. With these companies that are not growing quickly, the fair value it's like a thin band, okay? Because again, the company's not growing quickly. Up there at $34, I sold my shares. I didn't know that this was going to be the top of the stock. I had no idea what the future held. I just thought the stock was looking expensive. And now if we take a look from that point, we can see that TELUS shares are now down something like 36% from that peak where I was selling my shares. I didn't absolutely top ticket, but they're probably down about 33% from where I sold my shares. And this is over 3 years later. So if I held on to my TELUS shares and I didn't sell my winner, then I would be sitting on now a loss over the next 3 years, and my capital and my gains would have just completely evaporated. What I did instead is I took that money and I invested it elsewhere, and my money has been able to continue compounding. So in this situation, I was 100% dead right for selling my winner and putting the money somewhere else. I also did this with another stock called Storage Vault. The ticker symbol is SVI.TO. I have it in my notes over here. I sold this stock at $5.14 in March of 2024, which was right around here. This stock is now down something like 22% since my sale, and that was about a year and a half ago now. And the money, I took it and I invested it elsewhere, and it's continued to go on and produce gains for me. So in this specific scenario, it was worth it to sell my winner and go and buy other stocks. And I did the exact same thing with Cargojet. I sold my shares around $128 Canadian in 2023, and now the stock is at $104. So 2 years later, I would be sitting on about a 15 to 20% loss on this one. So no, I do not subscribe to the thinking where you should always hold on to your winners and you should never think about selling them. And if you're up on a stock, then it's just a hold forever. You should never let it go. I don't think that investing is black and white like that. And I also think that stocks can become overvalued and they can get to a point where they should be sold. It's funny because Buffett, the guy who says that his favorite holding period is forever, actually wrote, and I think it was his 2003 Berkshire letter to shareholders, that he regretted not selling his largest stock positions during the Great Bubble. And I think the stock that he was talking about was Coca-Cola, because Coke was selling for over 50 times earnings during the Great Bubble, during the tech bubble. And I think the business was growing at under 10% annually. So Coke was selling for 50 times earnings and growing less than 10% annually. That's clearly massively overvalued. And then Coke shares went on to do nothing for 16 years, or I think it was something like 13 years. I'm going off the top of my head right now, but it was clear that Coke was overvalued. Then its share price fell, and then in 2003, Buffett admitted that he wished he sold the stock. Buffett also has a 3-minute YouTube video that I wanted to play, but I think that this video is getting a little bit long now. And in that YouTube video, he says there are 3 situations where he would sell a stock. The 3 situations where Buffett believes that you should sell a stock are when you find something better, when the stock becomes expensive, or when the fundamentals and your thesis change. Those are the 3 situations where it can make sense to sell a stock, no matter whether you're up on it, you're down on it, or whatever. If the stock gets expensive, if you find something better, or if the fundamentals deteriorate and your thesis changes. Now in this video, I am obviously cherry picking some of my sales that ended up working out. There's also been sales that did not end up working out. On my YouTube channel, I made it very clear that I was buying Meta at around $100 per share when it was absolutely tanking in 2022. And then I ended up selling those shares around $260. I made about 160% within a few months. But in hindsight, that was a terrible sale. So it's not black and white. And in hindsight, yes, holding on to my Meta shares would have been the better option. But there's also situations like with TELUS where I clearly made the right decision to sell the stock and move on. I actually track my performance and all of my sales and what I put the money into instead to see if I'm a net positive. And I am happy to say that I am at a net positive, and so far it has been better for me to sell the stocks that I've sold and put them into the stocks that I have higher convictions on and think are offering more value. So that's my perspective on selling your winners. I think that sometimes it can make sense. It's not black and white. And I think that everyone should look at their positions individually and analyze them individually. Just because you're up on one stock doesn't mean that it's a sale. You could be up on another stock and it could be a sell if that one is overvalued or if its fundamentals are deteriorating. So that's what I think on the whole you should never sell your winners topic. Now, the last discussion that I want to get into is about finance influencers sharing their portfolios publicly and if they should. So this was actually a pretty heated debate between Joseph Carlson and someone named Antonio on X. And it's because Antonio was like, I'm up 20x on all of these positions. I'm kind of paraphrasing right now, but he basically was like, I've made so much money on all of these stocks that, people should be following me. And then Joseph Carlson came in and said, show us the gains then. Basically, lightly calling him out in like a friendly way. It wasn't like negative or anything. No one was fighting each other, but it was kind of like a friendly banter. Like, you should probably share your portfolio then so that people can see that you're being legit and you're not just some random person on X saying, hey, I make a lot of money. You should follow me and buy my course. So my opinion is, if you're going to be a finance influencer and sell products to your audience, like courses or books, then you probably should be transparent with how much money you've made and what your returns are. Maybe not even share how much money you've made, but at least show your portfolio and how much your percent returns have been. I think that's pretty fair, right? Like, if you were going to try and sell a course to your audience, you should say, yes, I have outperformed the S&P, and that's why I'm selling this course to try and help you outperform the S&P. I don't think that it's necessarily like, if you're going to have a YouTube channel and you want to talk about stocks, then you have to share your portfolio, because I do understand that not everyone wants to share their finances publicly. Like, I don't necessarily love that people know how much money I have in my portfolio, especially over on my Patreon, because I share everything, even my savings accounts. Like, over there, I track my net worth for my Patreon community. They know exactly how much money I have, even in my mortgage, what's my home equity, what is my net worth. I track it for them monthly. It's kind of uncomfortable, but I also kind of like being extremely transparent. But on that topic, I can see how someone may not be comfortable with the entire world knowing how much money you have. Like, just ask yourself, would you be comfortable with literally the internet knowing all of your finances down to the freaking cent? I can kind of get that argument. So for me, I kind of draw the line at, if you're going to be selling stuff to your audience or you're going to be selling courses or whatever, then you probably should just be more transparent and let them know what your returns are and if you're actually someone who can outperform the market, and if not, why, and what your strategy is, and just be open about it. So that's kind of the way that I lean. And I apologize if I'm looking at my computer. It's just because I have notes and I want to just kind of talk through my thought process here. So I used to track a YouTube portfolio on my YouTube channel. I made it very clear that this was a paper portfolio, that I was going to track about the stocks that I discuss on YouTube to see if I could outperform the S&P 500 over time. I stopped doing this. I still have the portfolio in Stock Unlock, but I stopped tracking it for the YouTube channel because it was consistently not a highly watched video. Like, when I would post these portfolio updates, it would be like a 10 out of 10 on YouTube, which means that it's a low performing video. A 1 out of 10 means that your video is performing very well. So it just seemed like people didn't really care. And whenever I would make these videos, not a lot of people would watch them. So I was like, I'm going to look at the data and just say, people don't really care about these YouTube portfolio updates. So I stopped tracking it because it was quite literally harming my channel and my viewership. So what I do now is I track my real portfolios, my actual real portfolios. I consolidate them all into one portfolio, and I track that for my Patreon community. And I do monthly portfolio updates where I track my progress, what I'm buying and selling, what I think the fair value is of all my positions, all of the positions that I own in my portfolios, why I own them, and I also track my net worth. So my Patreon community sees all of it. They see my monthly portfolio performance, my all-time performance, every stock I own, what I think is cheap, all of it. It's pretty much as transparent as you can possibly get, even down to my savings accounts, okay? Like, my cash that I have in my savings accounts is even factored in to my returns and all of it. But I do put that behind my Patreon paywall now, and I do put it behind my Patreon community. And the reason for that is because I have started investing in a lot more international, smaller cap stocks, as I have been talking about on my YouTube channel. And one of these companies, for example, has a $20 million market cap. This is pretty uncomfortable for me if I wanted to talk about this stock on a public YouTube channel that's my size. I have 260,000 subscribers now. So if I go out and I make a video on a $20 million company, the reality is that it could generate a lot of investors to become interested in the stock and want to go out and buy it. And that could cause the share price to go up 300% in a freaking heartbeat. That would make me start to look like a stock promoter. And that's something that I don't want to be labeled as. Your reputation is incredibly important. I think that your reputation is one of the most important things that you have, especially in the business world. And if you're self-employed, even if you're an employee, your reputation is so important. So you have to think about the reputational aspects of the decisions that you make. Is it going to increase your reputation or is it going to harm your reputation? This is something that I learned from Buffett, by the way. He defended his reputation more than his money. And I think that I would harm my reputation if I started making videos on micro cap stocks that have $20 million valuations. And then after I make a video, they potentially go up 300%. That would look terrible. I love investing in these companies. I think they're great companies and I think they have the potential to produce very high returns. So I want to buy them, but I don't want to make videos on them. That's a hard line that I have set for myself. I got into a debate with someone who watches my YouTube channel probably about 2 weeks ago. And he was saying, well, why don't you just make the videos? Like, you're just making excuses. You should just make these videos. It's a hard line. Okay. It's a non-negotiable for me. I know it sucks. I know you watching this video, you're probably saying, oh, well, I want to know what stock it is. But I'm sorry, I'm just not going to share it publicly on a YouTube channel. And that's why I have moved away from sharing my portfolio publicly. Because then because it gets into this point where it's like, okay, if I share my portfolio publicly, but I block out these positions that are small caps, then I know people are going to get upset as well. And they're going to be like, well, why don't you just share your entire portfolio? Or why are we missing out? Or they're going to say, you want to go and send us to your Patreon. This is just you trying to sell us on your Patreon. That's also a bad look. So what I've just decided to do is my portfolio is behind my Patreon community. And if you want to see it, you have the option to go and pay for it. Okay. That's kind of where I landed. My Patreon community is not massive. It's decent, but it's not massive. And what I've noticed is when I talk about these small cap stocks in my Patreon community, the share prices don't jump up. Okay. There's no like massive boost. So that either means the people in my Patreon are thinking for themselves and they're not just copying my trades, which is what everyone should do, by the way. You should never copy a YouTuber's trades, even my own. Do not do it. You have to have your own convictions. But it means that people are either they're not following me blindly into stocks, which I absolutely love, or my Patreon community is not big enough to go and influence stock prices, which is also a goal of mine because that's not what I want to do. I do not want to be influencing stock prices. So yeah, that's kind of just where I've settled. I feel comfortable with it because it's clear that people are not buying the stocks that I own just to go buy them, and I'm not manipulating stock prices, and I'm not, yeah, that's just kind of where I've landed. It's working for me. And people still have that option. If you want to see what I own, if you want to see all the stocks, you can head to my Patreon. They're all there. I'm very transparent over there. And that's just kind of the happy middle ground for me. Now, another reason why I don't share small cap stocks is because this actually goes back to Buffett again. He likes to hide the stocks that he's buying because he doesn't want other people to go and buy his positions to cause the share price to go up, because then he doesn't get as good of a deal. I think the exact same way. Again, if I shared a $20 million market cap stock that I think is very high quality, growing extremely well, with 260,000 investors, it would remove the undervaluation because people would potentially go out and buy it. It would remove the undervaluation, and it would then remove my ability to go and buy the stock and continue putting more of my cash over time into the stock. So I would remove my ability to perform well as an investor if I shared all of those small cap stocks with 260,000 people. That's also on my mind. I like to buy cheap stocks. I love doing the research. I love finding these undervalued businesses that I think are high quality and can probably outperform the S&P going forward. And I like to bet on myself, bet on these businesses, and be proven right. But if I go out and I find these stocks and then I make videos on them, and then their share prices go up, then I remove my ability to potentially continue plowing money into that stock for the next year at an undervalued price. So there's also that incentive where I'm actually not incentivized to share these things. Because at this point, my portfolio has gotten to a point where I actually make significantly more money by being a good investor than I make on YouTube now. Like my YouTube channel makes $30,000 per year Canadian, which is like $5 US. No, it's probably around, sorry, I got cat hair on me. It's probably around like 25,000 US dollars. That's how much my YouTube channel makes now. So yeah, it's like all of these things are weighed into my considerations on what I do, and I'm just trying to be open with you guys and explain my thought process. But the point there was I actually do make more money off of my portfolio now than on YouTube. So I'm actually incentivized now to protect my portfolio, my returns, than make YouTube videos on stocks that I own. So that's one big bucket for me to say, just go to my Patreon if you want to look at what I'm doing in the markets now, okay? And if you want to see everything, if you want to see my portfolio, my performance, you have the option to do that. So that's how I personally am incentivized now on YouTube. I also do have Stock Unlock. I also obviously do have my Patreon. And just like as a businessman, you should know this as my audience, but as a businessman, I am incentivized to send people to my Patreon, and I am incentivized to send people over to Stock Unlock because those are my businesses and those are my two main sources of income now. YouTube really isn't a major significant source of income for me anymore. YouTube has kind of become the place where I get to go and express my creativity. I genuinely love making videos and growing my YouTube channel. It's fun for me. And it's also become like that. It's become my outlet to be creative. And that's what I use it for. But in terms of where my actual revenue and my financial incentives are now, it's very clearly Patreon and Stock Unlock, and also investing, because my portfolio, as I said, makes a lot more money than YouTube now. So I just kind of wanted to be upfront, share my thought process, why I do the things I do, and where my incentives lie as a financial creator. Now, to wrap up this video, I do want to give you guys something because, you know, I do love you guys. I love my audience. So I do want to share one international stock that I have been actively buying. And this one is VTech. The ticker symbol is VIT.B, or VIT space B, sorry. This is a Swedish software company. It's a serial acquirer of software companies. It's very similar to Constellation Software. It's located in Sweden, and its market cap is about 1.8 billion US dollars. So this one is a mid-cap stock. It's not like a small cap stock that I was talking about earlier. That's why I'm okay to share this one on my public YouTube channel. This company, I think, is extremely high quality, and I also think that it is offering a discount in the market right now. I'm not going to go into my full investment thesis. I have a full hour-plus long deep dive for my Patreon community on why I bought this stock, how I'm buying it. You have to use Interactive Brokers. But yeah, I wanted to give you guys something. So if you're looking for research candidates in the market and in the international markets, I personally think this is a high-quality company with great management, a fantastic track record, and it's also, in my opinion, undervalued in the market today. It's about 5% of my portfolio now, and I am going to be tracking it in my Patreon. I am not going to be talking about this one publicly, but I wanted to let you guys know and give you guys a stock to go and research that is in the international markets to show you that I'm not just blowing smoke, okay? I am actually researching international stocks, and I am actively buying them. This is one of them, and I think that this is a very high quality company to add to your research list. So if you're interested, go and research it. And that's going to wrap up the video. That's my gift for you. I think this video is going to be extremely long, but you know, it's been 2 weeks, so I think that's fair. But yeah, that's going to wrap up the video for today, everyone. If you enjoyed the video, please remember to leave a like on it. And if you are interested in checking out my Patreon community, I will put a link in the description, or you could just head over to patreon.com/DanielPronk, and you'll get access to my portfolios and everything like that. And if you're new here and you want to stick around and see more content like this, then please consider subscribing to the channel as well. But for now, that's going to wrap up the video. So thank you everyone so much for tuning in. I really do appreciate it. And I hope to see you all again in my next video.